Good morning, everybody. Today is Monday, April the 13th. Welcome, everyone. So, as I kind of mentioned before we started the show, I'm missing my brother, my cohort today. He had a great presentation that was pulled together around creative financing solutions that will help expand your buyer pool. Unfortunately, he is out with a kidney stone, so I'm going to fill in and kind of do our best to kind of walk you through some of the materials here. So the kind of concept and the background on the topic itself is that it's not always easy finding buyers. It's not always easy finding clients, right? And I can look at this more from the mortgage perspective. One of the things we always talk to our newer loan officers, or even when we're recruiting loan officers, we ask them about where they're going to find their leads, and we talk about, when you do find your leads, you really have to work with them. You have to find ways to help them get qualified. But what you never want to have happen is to have a qualified lead or somebody that you're developing a relationship with where you have to say no to them, right? And that's kind of what this is about. It's like, how do we take these buyers? How do we take these clients of ours? And instead of saying no, it's more about maybe not now, or maybe
I gotta go take a
right? Because for a buyer, it's never, hey, we can't help you ever. Okay, we may have to put them on a plan of some kind. And this is part of the work that we do from a mortgage perspective. We try to find ways to be creative around financing solutions, either to help them qualify for that home, to qualify for that property at this point in time, or at some point in time down the road. It could be 3 months, 6 months, a year. It really just depends on that individual situation itself. But this is also one of the reasons why we love being a mortgage broker instead of being a bank or being a lender. And it's because we have the ability to work with hundreds of different lenders and offer thousands of different programs, so that if we're working with qualified borrowers, okay, or somebody that we can put onto a plan, there will be a way that we can find a way to get that opportunity done. But specifically around the financing solutions itself, okay, there's a number of different problems that may come up for your clients, okay? So if you're dealing with somebody who's a buyer, they love the house, there's obstacles that may come in the way from them actually saying yes and moving forward with buying that house itself. And we've seen all types of reasons for this, right? We've seen buyers that say, hey, the rates are just too high. I'm not happy with the rates are. I'm going to wait for them to come down. We've seen deals die because they don't like what the monthly payment is. It just doesn't fit within their current means. It doesn't fit within their current budget, even though they may qualify. We've seen people like self-employed individuals get turned down by banks and think they can never get a mortgage, and so they're gonna pass on buying that house, or they're not going to qualify for buying that house. And then we've seen first-time home buyers who just struggle with coming up with cash. And there's, again, lots of different reasons for what that is and what they believe they need to come up with, and we're going to talk about that a little bit as well. So what we kind of look at here is that there's, at least in the context of today, really 4 different buckets of these hidden buyers that are out there. So these hidden clients of yours that you may be working with, but they might be coming up with reasons why they either can't move forward with a particular home, or they don't feel like they are ready at this point in time to put in that offer. Kind of the same thing we talked about before. Those payment constrained buyers, the rate sensitive buyers, the ones that don't have enough money for down payment and closing costs, and the ones that seem to be unqualified. So we're going to talk about each one of these in a little bit more detail. Okay, so the first one, these payment constrained buyers, right? These are individuals that they may have a monthly budget, okay, and they don't want to exceed a certain dollar amount every single month at this point in time for their mortgage payment. Okay, they may qualify for a $900 million home, but because of where their their monthly payments are, their desired monthly payments are, they may only get in, they may only afford a $700,000 home. Okay, we may have to kind of ratchet that down in order to qualify at that point in time. But there's options, right? The options, and one of these options being a buy down option. So again, with these individuals themselves, knowing that they had that monthly budget, and I remember dealing with clients like this. I'm actually dealing with one of them right now. She is a teacher. Okay, she doesn't want to be beyond a $2,000 a month budget for her mortgage payment. And it really constrains what size home she can afford. Okay, but one of the solutions that we talk about are these buy downs themselves. And so the way the buy down works, okay, is this is actually a seller concession. Okay, so it's money that the seller would come forward with that would help reduce the interest rate for up to 3 years of the mortgage. Okay, so if they qualify for a 6.5 rate, that first year could be a 4.5% rate, which might take it down by that $500, $600 a month payment for year one, when maybe they're in that first year of their job, or they haven't gotten the raise yet, or their budgets are constrained in the near term because they're newlyweds. Okay, but to have that kind of short term, 1, 2, 3 years where your monthly payments are reduced, can really help turn that buyer into someone who's going to say yes to that either larger home or larger mortgage payment. Okay, so that is a seller concession that can be applied to that buy down specifically itself. Another way that those concessions can be used is it can reduce the rate permanently. So instead of being a 6.5% rate, maybe it's a 5.9% rate, and that's enough to satisfy what the monthly payments are going to be for that particular individual. Okay, that couple $100 could be a huge difference from somebody saying, no, sorry, I'm not going to move forward with this home because I feel like the payment's too high. What we're also starting to see a lot more of are adjustable rate mortgages, which used to be really popular. They are starting to come back. And these adjustable rates are essentially saying we're going to fix your interest rate at a lower than market rate for 3 to 5 years. Okay, typically we're seeing the 5-year ARM being the one that's pricing most favorably. But for that first 5 years, it's going to be maybe a half a point, 3/4 of a point below what the market rates are. And we're seeing this more around FHA mortgages than we are for conventional. Okay, but again, what that does is it's going to lower their payment. And we've taken people who don't qualify into qualifying by moving them into that adjustable rate mortgage. We know that especially if they're moving that with an FHA, they're going to be refinancing within 3 to 5 years anyway to remove mortgage insurance premiums that are associated with their monthly payments. So we are seeing those be more and more attractive. And it is, again, a way of bringing a lower rate in the near term to help more of your buyers qualify and feel comfortable with their payment. There's also the concept of buying out the mortgage insurance. So in certain situations, when people are not putting down 20% on a conventional mortgage, okay, they're going to have mortgage insurance that they're responsible for paying. And that could put their monthly payment up to a level where they're not comfortable. Okay, there are actually options, especially if they have a little bit of additional cash sitting aside, okay, that they can buy out that mortgage insurance. It'll lower their monthly payment. Did they have to, bring a little more to the closing table? Yes, but their monthly payment on a go-forward basis is not going to be a problem. And it really just comes down to the individual. I think different people budget differently. Different people manage their monthly payments differently. And, for some, these approaches towards lowering that monthly mortgage payment, helping it fit within their budget, is going to help them say yes, where, in certain situations, they might be not as comfortable moving forward with a larger home or a larger payment. The next set of individuals. So, I think we've all probably heard this a lot, around interest rates and interest rates being high, and they're too, we're going to wait for interest rates to come down before we actually look to buy. Okay, absolutely. Are interest rates higher than where they were the past couple of years? No doubt. Okay, historically, and we feel like we have these conversations on a regular basis, the rates are not significantly higher than where they've been historically. We'd love to see them back down in the 3-4% range. We do think they're going to get into the low fives within the next 18 months or so. But that rate of 6% or 6.5% is more with the norm of what we've seen from a historical perspective. It doesn't make people feel comfortable though. So, what are those approaches in order to help address those rate sensitive buyers? As we kind of just talked about, we have those adjustable rate mortgages where they can start out at a lower interest rate. So they start at a lower interest rate, again, 0.5 to 0.75% lower for many borrowers for the first 5 years, and then it'll incrementally go up. Those adjustable rate mortgages are going to be primarily for those who are only going to be in that house for that 3 to 5 year period of time, or who know that they're going to be looking to refinance in a couple of years for a variety of reasons. There's also the strategy, and this has been around for a while, the marry the house, date the rate, right? Yes, rates are high, they're going to come down. In the future, if you love the house, go and buy the house. We can always adjust the rate, in the future as the markets recover to an extent. Still a very sound strategy. Okay, the challenge that exists out there is the fact that if people are waiting for those interest rates to drop, what that's going to do is it's going to bring more and more people off of the sideline. And as more people move off of the sideline that we're waiting for those rates to drop, you're going to have a lot more attention to those homes that individual is looking to buy, which is going to drive up the cost of the homes. So if you're working with a buyer who's saying, oh, I think I'm going to wait until the rates drop, the conversation around now may be the best time because you're going to have the best opportunity to come in at asking price, I don't know, maybe less than asking price depending on your market, because there's not as much competition. It's just an important conversation to have with them sooner than later. The higher rates are not great for anybody, but if the rates are higher right now, they love the house, go in. Put the offer in. You're going to have less competition. You're going to get it at a price point that's potentially more with what you are looking for. And then the whole starter home mentality. We are seeing that because the rates are a little bit higher, that the ideal home that people are looking for, they may not be able to afford, regardless of the number of programs we have, regardless of the ways that we can finance and creatively finance their what they can afford. They may still not be able to afford the $1 million home. Okay, they can only afford that $500,000 home for certain reasons. The idea that, hey, this can be a starter home, get into the market, build equity in your home right now, and leverage that equity in the future to getting yourself into your forever home, right? I mean, these are all concepts I think we're familiar with, but now more than ever that one becomes important, especially as rates and monthly payments have been a concern. And then we're dealing with, as a kind of third grouping, these individuals who are cash constrained, right? They don't have the 20% down payment that many people feel like they need or require. So there is that misnomer that's out there, and I think that the message is starting to get out, but it's still not out on a wide basis that you need, the old 20% down in order to be able to afford a home. There are programs out there that it's where the down payment is significantly less, especially for first-time home buyers. If you're a first-time home buyer and you qualify for a conventional mortgage, you only need to put 3% down. if they're not a first-time home buyer and they're still conventional, you have to put down 5%. But that's it. It's 5% of that purchase price that you actually have to put down itself. If it's an FHA mortgage, it's always 3.5%. Doesn't matter if you're first time or not. But there's also things like down payment assistance programs, and there are state bond programs you have to qualify for them based upon your income and potentially the value of the home. But there are those grants and forgivable loans that exist out there where people can get money from local government agencies in order to help pay for down payment and closing costs. And those down payment assistance programs are typically provided from our lenders. They might come with a bit of a higher interest rate, but if it's about coming up with the money that you need for down payment, we have the ability to go through and do that. We have the ability to find that money itself. But there's also loan programs out there, and there's a few of them that are coming out, I think, again, that used to be popular. But I mean, USDA loans, okay, so anything that's rural, it's a 0% down payment, right? You don't need to bring anything. Same thing for VA loans. VA loans, you don't need to bring anything. So, for those loan types, and again, it's not going to be for everybody, but if we have borrowers and properties that fit within those categories, you don't have to bring any money to it. But what we've seen that coming out recently, and this is for more of our, what will become high net worth clients and borrowers, are doctors and physician loans, right? These used to be really popular. But the way they work is they're also a 0% down for almost any home size for these doctors. The guidelines are quite relaxed. Again, they don't come with the lowest of interest rate. The interest rates I've seen are a little bit elevated in comparison to what the norm is. But these lenders and the banks that are offering these doctors and physicians loans are banking on the long with these guys, right? They're going to be making a lot of money down the road in their career. But if they just graduated medical school, or if they're in their residency and they're looking to buy a home, they are willing to essentially forego the down payment. They don't have any mortgage insurance, which actually helps with the higher interest rate, right? A little bit of a higher interest rate, but you don't have any mortgage insurance. It's a nice trade-off. So for a lot of these individuals, whether they're first-time home buyers or not, there are ways to get them money, okay, that might put them in that home that they weren't necessarily comfortable with without having the access to that additional cash. And then lastly, we have those borrowers that were typically turned down from every bank that was out there, right? The buyers that are self-employed, typically, the ones who are really smart with working with their accountants. So their tax returns don't show a whole lot of income. The ones that need an alternative way of determining and calculating how much they actually make. And this could be anything from individuals who are commission-based. It could be people who maybe they took off a year, they didn't work last year, but they are sitting on a lot of assets in investment accounts. We saw this happen during COVID quite a bit. There were people who were self-employed, but their jobs kind of went away, like DJs and things like that, who were very successful and had to basically put their careers on hold for a year or two when there were no opportunities to go out and entertain. There are loan programs and there's ways to get mortgages for those individuals as well. There's lots of different, I'll call it alternate income programs that exist, right? These are things like bank statement loans where you will calculate their income based on how much money goes into their bank account each month. And it's a percentage of it, right? So by default, it's like 50%. So if you're pulling in 20 grand a month from whatever you're, on average over the past 12 months, you're getting credit for $10,000 a month of income. If it's a service-based position, right? As in mortgage professionals or realtors or insurance agents, where you don't have a lot of overhead, they're going to give you 90% credit for that. So that same $20,000, that's $18,000 of income they're going to give you credit for, regardless of what your expenses are. They're not going to look at your expenses. There's also profit and loss loans, where as long as your accountant is writing up and signing whatever your profit and loss was, and it can be different than what was on your tax returns, this is profit and loss for your business, you can get a loan based on that. The asset-based qualifications, these are, I'm sitting on $1 million in my 401k account or in my investment account, because I picked some really good stocks. Those are all qualifying assets that can be leveraged as income, because they're going to look at it as, hey, you can potentially be draining down a percentage of that every single month. So there's lots of different ways of qualifying these borrowers and getting them approved for a mortgage so that they can buy that house. But there's also, and this one I think is one of the more interesting ones that are out there. And it kind of reminds me of the subprime loans from back in the 2008 days, right? Or pre-2008 days. Although it is not, this is completely legitimate. And there's only 2 lenders that offer this, but it's a no income loan for primary homes. So you're going to go buy your primary home. Okay. I don't care what you do. And I don't care how much income you bring in each month. I don't want to know anything about your job. What you need to do is you need to show that you have a good credit. You need to bring in 20% from a down payment perspective. And you need to have enough reserves that you can carry the mortgage payment for a year. Okay, so you need a lot of, money on hand, right? You need assets. But as long as you have that, you can get a mortgage. So it doesn't matter that you haven't worked, or maybe you work, you don't want to show what you make. It doesn't matter. You can get a mortgage based on those 3 things alone. So point being is there's a lot of individuals, there's a lot of buyers out there that when they go to a typical bank and try to get approved, when they go to some direct lenders who have a small number of products and try to get approved, and somebody says no, there may be other ways of qualifying them and saying yes to those buyers themselves. Right? So in general, so really, what's the impact? The impact is that us from the mortgage side, but also, from a real estate side, there's opportunities that may be left when we're not looking at all different approaches towards how we can find financing for those home buyers. What we ask in general is, let us have conversations with them early. Let us come up with multiple scenarios, different ways of strategically financing and coming up with the right products and solutions for them. So we can understand what can they afford now. And if it's not now, it's 3 months from now that they can be approved for that home that they're looking for. We have, again, the thousands of different loan products that are available to us across all of our lender base. We're going to find a way, and usually multiple ways, of having that buyer or having those buyers qualified for the home that they're actually looking for, and having to get comfortable with the payments that they are looking to make to stay within their budgets. So again, the ask is, let us have conversations early before potentially passing on the buyer, or before they say, no, sorry, I'm not really interested in that home because I don't feel like I can afford it. Let us take a look at the opportunity. Let us take a look at the deal. If we can find a better way of doing it and getting them comfortable, it could potentially help drive additional business, and it could keep those buyers focused on purchasing that home itself. So we are certainly here to try to help you grow your business from that perspective. We are more than willing to take a look at anybody that's in your pipeline that we're struggling to find to get a yes for. Okay, so I don't know if there's any questions on the materials that we kind of shared so far. Or maybe people have had scenarios or situations where they've potentially had to say they've heard no from the financing side that they wanted to share.
Chris, I ran into a woman that works for the county, and they have these programs with the income limits, but for first-time home buyers that offer like $40,000, up to $40,000. It's a loan, but there's no interest and there's no payments made. It just gets paid back if and when the property refis or gets sold down the road. Have you heard of those types of things?
Yes, yeah. So
Yeah.
these are typically the county or the state bond programs.
Right.
Yes. So like PHFA.
Yes.
Yep. Yep. So there's so in Pennsylvania, it's the PHFA. In New Jersey, it's the NJHFMA. There's one for Delaware. There's a Florida bond program that exists. Yes. So these are again state or locality based funding mechanisms. We just sat in on one in someplace in Maryland, but it was very specific. It's just one county, right? And it was the same type of thing. It was $40,000 or $50,000 up to that they were willing to pay towards down payment and closing costs for qualified borrowers. And if, as long as they stay in the home and don't refinance for 10 years, it's forgivable.
Right. I thought
So
that was really interesting. That's a
as
great.
long as they're for 10 years.
I think there were income limits on it. Like,
Absolutely.
if it was one person, I think it was like 65,000 a year, and then if two people was up like 75,000 or something like that. But
Correct.
for people just out of college, or it seemed like it might be a good tool to use for first time home buyers.
Absolutely. Absolutely. Yes. It's one of those. It's not offered in every location, but when it is a great tool, and it needs to be added and introduced to all of our clients for sure.
Yeah,
now,
the woman that I was talking to manages Chester County, and they only did like 4 last year. I was like, that sounds crazy to me. Yeah, and the whole county. And I think it's just because people don't know about it for the most part.
It's possible. I think so, but I think that actually brings up a really interesting point, Dan, because every loan officer and every lender does not have access to all of those programs. Right. So, so if it's just a bank, and they don't have a relationship with that particular county, or they haven't signed up and subscribed to it, they may not be able to offer that grant program. And then you have loan officers who might be either out of region or just don't even know to ask the question of, is there another way of getting financing or getting, that down payment assistance for my borrowers. So all lenders aren't created equal and all loan officers aren't created equal. You really need to be looking at it holistically, and you need to have people that are going to find solutions and a holistic solution for your clients. So
yeah, I agree 100%. Anyway, this is great. Thank you.
No, thank you. Any other questions or comments?
I know that these are for buyers that are going to live in the properties, primarily residential, but do you guys also have loan products for investor type buyers?
Absolutely. Absolutely. Yes. So I think we were focused on buyers, at least in this presentation, for buyers for maybe their primary home, but it is not exclusively for those individuals. So for investors, I think there's a few different things, right? I mean, investors can qualify for conventional funding, and you're going to have typically better interest rates from a conventional perspective, but there's a lot of other programs out there that we can offer that are that are investor specific. So the debt service coverage ratio, the DSCR programs that exist out there, where again, we don't need to know anything about the individual's income. We just need to make sure that the mortgage payment can get covered by the rent on that property itself. So yeah, so those programs exist as well. And the only thing that really, from a qualified borrower perspective, matters is that their credit scores is okay, right? I mean, if they've shown that they can't pay back, their current mortgage on their primary home, for example, the lenders aren't going to necessarily be comfortable lending them for an investment property. But as long as their credit score, I think, is over like a 620 or 640, there's no issues typically getting one of these investor loan programs. But that is only one type as well. I mean, there's also just your standard fix and flip and renovation loans, which might be better suited for investors as well.
Thank you. Maybe you guys can do a training that focuses on those type of loan products.
I think that sounds like a great plan. Thanks, Anna. I will take note of that. Other questions or comments?
Oh, good. Thanks, man.
Thank you guys very much. I appreciate the time. I'll leave you with two thoughts here. I think we left these a couple weeks ago as well. It's really just the reminders of some of the things that we offer from a United Home Loans perspective. We are offering lead generation through a platform that we subscribe to. So anybody that has listings that would like to have them boosted on social media through Facebook and Instagram ads, we will do a campaign for a month for you for your listings. And then we have our United 360 program. So for folks that are interested in legally being compensated on the mortgage side of your real estate transactions, that's what this program is all about. Okay, it's a way for you to get paid on the mortgage side, whether it's a purchase, a refinance, a home equity line for your clients, or any of the above. So happy to talk to anybody about either of those. Feel free to reach out to my brother or myself.
Thanks, Chris.
All right. Well, thank you guys. Have a great week.
Thanks, Chris.
This was
You
great.
too.
Appreciate it.
All right.